JPMorgan, Wells, Citi kick off earnings today. All three topping expectations with second quarter beats. And next week, of course, Goldman, BlackRock, B of A, Morgan Stanley. Erica Najarian, UBS large cap bank and consumer finance analyst, joins us this morning. She has a buy on JPMorgan Wells, neutral on Citi. Happy Friday, Erica. Good to see you.
Happy Friday, Carl.
Looking for narrative threads. Is it about some of these numbers on IB revenue, or is it about expense control? What are you looking at?
So this is actually an extension of what you guys just talked about earlier in the segment in terms of, what's happening with the market. These large caps have massively outperformed the regional banks to start the year. And so the bar for today was, pretty high. And so when you pair that with the excitement of a rate cut that was ignited yesterday, which would be better for regionals than it is for the money centers, and then you saw, Wells Fargo coming in at the, lower end of their guidance for net interest income, JPMorgan numbers not going up, and Citi having all this uncertainty with, continued regulatory issues and what that means for expenses. I think what you're seeing is essentially, perhaps the beginning of, some reversal of this money center outperformance trade.
Really? That would be a big turn after large sections of the street got positive on large cap banks maybe 6 months ago.
Absolutely. And they were very much valid to be that positive 6 months ago. You had really the big catalyst of Basel III endgame capital rules not being as bad as feared. But now here we are on the eve of a potential rate cut. And obviously, the market is also starting to think about the election. And the one thing that's interesting is that regional banks and mid-cap banks don't normally trade at a discount to large-cap banks. They typically trade at a premium because of the potential for consolidation. And so if the market starts thinking about a Trump victory and how to invest in banks based on that catalyst, I think consolidation is a big theme, and they're going to buy the sellers, not the buyers.
We're looking at shares of Wells Fargo now, Erica. You have a buy on it, I believe, but it was, a somewhat disappointing quarter, particularly given, I guess, a miss on net interest income. Has it forced you at all to reassess your recommendation?
Great question, David. No, not at this time. Look, at the end of the day, they did have a tough quarter, and the outlook is even tougher. No one wants to see numbers come down. And also, they had a higher outlook for expenses. And right now, the call is going on, and hopefully they're explaining that the strength in investment banking and trading could offset that increase in expenses. But at the end of the day, if we zoom out, if we think of the most, quote, Trumpian of the money center banks, we think it's potentially Wells Fargo, because not only do you have a true recovery story that very much parallels Bank of America's 10-year story that followed the global financial crisis in terms of recovery and ROE improvement, but the asset cap continues to linger as a negative. And I think that investors are thinking that if we have a Republican administration, that the chances of that asset cap lifting sooner rather than later is higher.
What explains the net interest income guidance falling between 8 and 9%? I get that they're more consumer driven and rates may have peaked, but why the outsized decline versus, say, a JPMorgan?
So there's two answers to that question. The technical answer is that they are coming from a lower deposit cost base. So any rate of change to go to market is clearly more significant for Wells than for others. But I think this is where the reputational issues, which are healing but still exist, come in. So if you think about Wells Fargo, they are not growing net new checking accounts in retail the way JP and B of A are. And so they have to lead with price. Additionally, they're starting to lean into corporate deposits, which are at market rate. And so what you're seeing is sort of a basing effect. But in reality, Wells has to be more competitive because it still has to shake its reputational issues.
Eric, I noted you mentioned the potential for a change in administration a couple of times. I'm curious, is that coming up a lot in your conversations now with investors?
It's coming up in every single conversation. And I think what's interesting is that while it's coming up in every single conversation with investors, the conclusion is that it may be too early to put on that trade given the uncertainty about who's going to be the Democratic nominee. So that leads me to conclude that, if the market starts thinking about a Trump victory and truly pricing that in, then you could see the same thing, an extension of what you saw yesterday in terms of SMID outperformance versus the large caps from here in banks.